Hello and welcome. Today, we're setting off on a journey. And this isn't just about crunching numbers. We're diving into a whole new investment world. We're going to unpack a new option that's popped up on the financial landscape, one that's really built for a very specific kind of investor. So, let's get into it.
So let me just ask you straight up. Have you heard of SIFs? It's an acronym you might start seeing a lot more, and it represents a brand new frontier of opportunity for investors. If you haven't, well, you're in exactly the right place.
So what are they? SIFs stands for Specialized Investment Funds. This is a brand new category, India's main market regulator. Think of them as professionally managed funds, but they're not for everyone. They're built for a specific type of investor, one who's okay with taking on pretty significant risk to chase potentially much higher reward.
Now, to really wrap your head around what SIFs are, the best first step is to see how they compare to the stuff we already know. Let's put them side by side with the familiar players.
Okay, this table here really lays it all out. See, on one end of the spectrum, you've got mutual funds. Pretty much anyone can get into those. On the complete other end, you have portfolio management services, or PMS, which are for high net worth folks investing 50 lakh rupees or more. SIFs, they're made to fill that big gap right in the middle, creating a whole new category for serious, well-funded investors.
And this is the magic number that carves out that middle ground, 10 lakh rupees. That's the minimum ticket to get into an SIF. SEBI put this high barrier there for a reason, to send a crystal clear signal that this is a playground for investors who know what they're doing and can handle some serious risk.
All right, so now that we're past the velvet rope, let's pull out the map of this new world. What does the SIF universe actually look like? What are our options? You can pretty much break the SIF universe down into three main families, or let's call them continents on our map. You've got equity SIFs, all about stocks. Then there are debt SIFs, which focus on bonds and loans. And finally, you have hybrid SIFs, which, yeah, you guessed it, mix the two. Each one is its own adventure.
So let's make our first landing in territory number 1, equity SIFs. No surprises here. These are funds that put their money primarily into company stocks, right? They're betting on the growth of those businesses to make a profit.
Now, inside this territory, fund managers have different playbooks. You've got the classic long-only strategy. That's basically buying good stocks and holding them for the long haul. Then it gets spicier with long-short. This is where you not only buy stocks you think will be winners, but you also bet against stocks you think are losers. And then there's special situations, which means jumping on opportunities created by big events, like a merger or some major company news.
Okay, on to our second territory, debt SIFs. Instead of playing in the stock market, these funds are all about the world of bonds and loans. They're looking for returns from interest payments and from shifts in bond prices.
The playbooks here look kind of similar to equities, just applied to a different world. A long-only manager might just buy and hold safe government or corporate bonds and collect that steady interest. A long-short strategy, though, is way more active. The manager might bet that interest rates are going to go up, which would make old bond prices fall, or the other way around. It's a way to play the big economic trends, not just one company's success. And that brings us to our final stop on the map, hybrid SIFs. This is where the worlds of stocks and bonds smash together. These funds are all about being clever with diversification, mixing both in a single portfolio. And the strategies here are pretty cool. A balanced fund tries to give you the best of both worlds. You get growth potential from stocks and a bit of a safety net from bonds. Arbitrage is a whole different beast. It's all about finding and exploiting tiny, fleeting price differences. Like, imagine buying a stock on one exchange and selling it for a tiny bit more on another, almost at the same time. These are super fast, high-volume trades that are designed to scoop up low-risk profit. Now, here's a huge part of what makes SIFs so, well, specialized. The pros running these funds have access to some secret tools. We're talking about financial instruments that can ramp up returns or put up a shield to protect the fund from losses. We're talking about derivatives. I know, the word derivative sounds super intimidating, but the concept is actually pretty straightforward. It's just a financial tool whose value comes from or is derived from something else, like a stock or a bond. It has no value on its own.
The easiest way to think of it, it's basically a contract that's making a bet on the future price of another asset. The two most common types you'll hear about are call and put options. A call option gives you the right, but not the requirement, to buy an asset at a locked-in price in the future. You do this if you're bullish, if you think the price is going up. On the flip side, a put option gives you the right to sell at a set price. You'd use that to bet on a price drop or just to protect an investment you already have. For an SIF manager, these are absolutely fundamental tools. Okay, so theory's one thing, but to really feel the power of these strategies, let's look at a couple of real-world stories of high-stakes investing. These examples show you exactly what's possible when you put these tools and strategies into action. Our first story is a pretty famous one, the Hindenburg Research Report on the Adani Group. Hindenburg is what you call a short seller. They specialize in finding companies they believe are way overvalued. And this was a perfect setup for a massive, high-stakes bet.
So here's the play-by-play. First, they did a ton of research and came to the conclusion that the company's stock was just way too high. Second, using derivatives, they put on a massive short sell position, which is just a fancy way of saying they bet the price would crash. Then they published the report, the stock price did exactly that, and they walked away with enormous profits. It's a textbook, real-world example of the long-short strategy SIFs can use.
But it's not always about making these huge, aggressive bets against one company. A long-short strategy can be used in a more balanced way. For example, a firm might think the tech sector is going to do great, but they're pessimistic about manufacturing. So they could go long on a whole bunch of tech stocks while shorting a basket of industrial stocks. By using derivatives to manage this, they're trying to make money from their specific insights, no matter if the entire stock market is going up, down, or sideways.
So, we've explored the map, we've looked at the tools, and we've heard the legendary tales. Now that you have all this knowledge, you're in a position to make the final judgment. Is this new world of SIFs a destination that's right for you?
SIFs are built for a very specific person, an experienced investor, someone who doesn't just understand the huge risks, but who also wants access to these kinds of advanced strategies that used to be out of reach. They need to have the financial and, honestly, the emotional strength to handle the ride. So, we've given you the map to a new and pretty complex investment frontier. It's a world of high risk, high potential reward, run by experts with some very powerful tools. The only question left is the personal one. Now that you understand this frontier, what will your investment journey look like? Thanks for joining this explainer. Stay smart and stay curious.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.